That is exactly the set of circumstances why I think the Fed was so late with the rate cycle this time around. Because they want these things to undershoot, because what they need to do is debase the currency to pay the debts.
Today, Real Vision CEO Raoul gives his prediction for the final months of 2023 and believes that we're now weeks away from an unavoidable collapse. The crash we're seeing of many countries' fiat currency shows that this situation is extremely volatile. The latest inflation numbers are also a sign of these systems' instability and is skyrocketing as we speak. Raoul emphasizes that the repercussions are tangible, impacting people's ability to afford basic housing and food, and predicts we'll see an inevitable run on the banks. He points out that not only is the economy spiraling, but an abundance of money printing and misallocated investments is contributing to capital disappearance. These events will be put on full display as we start nearing the last few months of 2023. Let's get right into the latest interview with Raoul as he gives his market prediction and what we can expect in the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
We're going to go into recession and therefore we're going to see a collapse. And really, what we're looking at is stuff that was already priced in again. So if we look at like imports and exports, we're seeing world trade falling. So here's the Eurozone imports from non-Eurozone countries, right? Collapsed. We've seen that everywhere. We know this information. This information was essentially that fall in the ISM. There's nothing new to know here. Yes, economic growth is incredibly slow right now. Yes, many countries are in a recession. Yes, some will avoid a recession. I do think the US is in a recession now, but that's what we see from this stuff. Also, if there's a recession, you see jobs falling. So here's job openings. Now, job openings are coming off sharply, and they will continue to come off until they get back to some sort of trend. Everyone frets over this bloody stuff every month, and really the forward-looking indicators have been calling it all along. It's going lower, it just takes time. These things are lagged, if you remember. Wages lag ISM, and they will eventually keep falling, and then we'll start getting negative prints, and people will suddenly wake up and smell the coffee, much like we've seen with the unemployment rate. It's like, oh, it's ticking up now. So it does come, but it takes time. And by the time non-farm payrolls are negative and inflation is below 2%, well, the market's well looked through this and it's looking for the recovery. But it also means that the cowbell, the monetary stimulus, the printing, and even the ability in an election year to add fiscal stimulus grows. And I think they want that. So the unemployment rate, so this is an inverted unemployment rate. So as this goes down, unemployment rate rises. Our GMI unemployment index leads by 3 months. It's suggesting unemployment is going to rise about 1% from the low. So we're starting to see that happening. So unemployment should start ticking up. Now, if unemployment's rising and inflation is falling, ding, 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 more cowbell. More cowbell, yield curve, interest rates start falling. Remember the financial conditions index? The dollar starts weakening. And what we get at that point is the financial conditions index showing further loosening. And that drives the next leg of a bull market. So I think the market continues into the end of this year. Then it might have a soft patch as the financial conditions index, which is forward looking, slows stuff down. And then from the cowbell, we'll see it going forwards. I'm not focused on the volatility part. I'm in this cycle for the full cycle, which I think goes into 2025, maybe even to 2026. So it's kind of for me as you strap in and ride the trend. The other thing to know about unemployment rate is every time it rises by 0.5% from the low, the Fed cuts. Every single time since about 1950. Now, you might say, but unemployment is crazy low right now. And that's true, but it doesn't necessarily lead to wage rises or ongoing wage rises. Japan has had very low unemployment. In fact, for the last 10 years, got a 10-year older population. It's had unemployment at 3.5% or lower, basically, barring a couple of recessions, for extended periods of time. And that's because as their older population leaves the workforce, the younger population has jobs, but they have to compete against friendshoring, offshoring, and technology. So wages over time still never really rise. So yes, we get some wage rises pushed through because of what happened last year, but generally speaking, we don't see any evidence of sticky wages or wage rises or some wage price spiral, any of that sort. It's just not evident in any of the data.
Amid this fiscal tightrope walk, Powell discusses the economic indicators we're seeing, as well as the debt dynamics and the pivotal role of central banks in shaping the market in the last part of the year. With an air of urgency, he also highlights the mounting concerns encircling the colossal $6 trillion debt maturation slated by year-end.
So now we've established that we think that the economy is currently in recession. We think it was priced last year by asset markets, and therefore they are looking forwards. Our financial conditions index, which is 9 months in the future, has been going up for a significant period of time. That called exact timing of the low in the ISM. The markets exactly followed suit. The liquidity cycle is driving. Here we are with a slow economy. Here we are about to see unemployment rising, non-farm payrolls falling, and inflation falling, and an ongoing deflation in core CPI. That is exactly the set of circumstances why I think the Fed was so late with the rate cycle this time around. Because they want these things to undershoot, because what they need to do is debase the currency to pay the debts. So let's not get ahead of ourselves. First, liquidity. Liquidity matters. And our GMI Weekly Global Liquidity Index actually lags our financial conditions index by 5 months. So that's very useful. It tells us liquidity is going to keep rising. It's going to keep rising well into 2024, where we might get this little air pocket. But don't concern yourselves with the wiggles. They don't mean a lot. Overall, directionally, we should be headed much higher in the global liquidity cycle. So that's what I'm expecting. So therefore, I cannot be a bear, because if there's excess liquidity, you're debasing the currency, so optically asset prices rise. And the assets I'm long are the secular trending assets. So those are the ones that naturally go up, like the NASDAQ and cryptocurrencies. Those ones are in a natural secular cycle, so they will continue to go up. Now, some of you might go, well, NVIDIA, that's so expensive, it's overvalued, blah, blah, blah. I don't care. It's liquidity that drives everything. We only need to worry about that stuff at the end of the next cycle, when inflation is coming back and rates are going back up. We're the opposite of that right now. We've got a lovely 18-month period of rate cuts, stimulus, and all of the good stuff. That's what you should be focused on. You shouldn't be focused on these other red herrings. They only matter when the cycle rolls over, and that's not for a period of time. So here's another longer lead. This is our GMI Weekly Global Liquidity Index versus ISM. So ISM has a 15-month lead because of the cyclicality of the global economy that we've talked about before due to the rate refi cycle. Well, that suggests that all of 2024 liquidity is going to be rising. So we've got a great year to come in 2024, all things being equal.
Raoul Powell uncovers how changes in cryptocurrencies can send ripples effects through our wallets. Imagine a world where borrowing money becomes more expensive. Those cool credit card deals and car leases might not be as sweet. But it's not just about numbers, it's about fairness and how many things we can buy. Among the market noise, Bitcoin emerges as a rebel in the money world, shaking up old traditions. Powell points out that the everything code is like saying money is this invisible thread that's connecting it all together. With big banks being the guardians of balance, he says they're working behind the scenes to keep things steady, preventing financial chaos, but he believes the inevitable is coming. What do you think about the latest interview with Raoul Powell? And how do you think his prediction for Bitcoin, crypto, and the financial market plays out in the last part of 2023? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.